We continue our discussion on unpacking and making sense of global economics. We're once again joined by Professor Azhom from Pakistan, who's a professor, economist and social scientist. Professor, assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Once again, it's an absolute pleasure to have you with us on the program. Today we talk about money. Now, when we talk about money, we generally refer to a current medium of exchange in the form of coins and banknotes. How would you describe or define money?
Well, this is a very deep and important question. And I would like to go back a little bit to explain the background, why this question is so deep and difficult. At this point, you know that about a handful of people, maybe 50, 60, own more than half of the planetary wealth. More than half of the money is owned by just 50 people. So how did this happen? One thing you have to understand is that this doesn't happen by force. Nobody is taking money away from us by force. It happens because we all willingly consent to a system which creates this outcome. So how can we consent to a system which creates such huge inequality? It is because we are fed false theories. So today, a PhD in economics at Harvard learns theories which are completely false about money. And it is on the basis of these false theories that we operate. And these false theories create the impression that the system is fair when in fact it is highly skewed. So in particular, money, the common understanding of money which is given by the textbooks and which we have in our minds based on our intuitive experience with money is absolutely false. So money, in order to understand money, you have to understand who creates money. This is the most important question, which is never asked. So, money. Yeah, okay, go ahead.
Okay, Professor Saab, so, how has the nature of money changed and evolved in the 20th century?
Yes, this is a very important question because actually money started out early 20th century as being gold. Even that's a very, very bad description. There was the gold standard and money was issued backed by gold. But in fact, the actual amount of money in circulation was much larger than the amount of gold available to back it. So even in that gold standard, there was a lot of deception involved in the sense that all of the money that had claim on gold was not backed by gold. This is the standard feature of the fractional reserve system. But when the gold treasuries were exhausted in World War I, then the gold standard became impossible, and ultimately in Bretton Woods, it was decided in the Bretton Woods Conference in 1944, towards the end of World War II, it was decided explicitly to go off gold, and instead the standard was replaced by the dollar standard, because the idea was that the U.S. economy was sound and the U.S. had immense amounts of gold, so the dollar would be backed by gold. So ultimately it was gold standard, but at one remove. It was called the gold exchange standard. After that, in 1971, Nixon removed the gold backing from the dollar because of expenses incurred during the Vietnam War. And since then, the entire system has been floating exchange, which is a completely new system for the world. There has been nothing like it before. And since then, there have been many further developments. So the main point that I want to make is that money is not just something simple like money. It has changed radically and drastically about at least 5 times over the past century. And in order to understand money, we have to understand this history and context and the functions of how the modern financial system works and how it differs from the same system in the 1970s. And very few people have understanding of this, and yet we are faced with the problem of handling this and making policies about this every day.
Yes.
So we are operating in the dark.
As you indicate that the system has changed over time, now if you came to the point of speaking of the floating exchange system, then in the 90s we had the rise of shadow banking. How do we understand what shadow banking is?
Well, basically, after the rise of neoliberalism, which started with the Reagan-Thatcher revolution, you see, basically in 1929, the Great Depression, the financial institutions were very strongly regulated because they had gone wild and crashed the entire world economy. So, but slowly the memories faded, and Reagan and Thatcher started the move to deregulate finance, and they started slowly removing all of the barriers that had been put in place to prevent the Great Depression. And so eventually the deregulation started. The first thing that was done was to remove the restrictions on savings and loan organizations in USA, and that almost immediately led to a great savings and loan crash, which cost about $80 billion, more than the earnings of the entire banking industry over the 50 years. But the financial lobby was very strong. It prevented the necessary reforms, and it started gathering more and more freedom until it became possible. See, the banks are subject to a lot of laws and regulations. So it became possible to create institutions which acted like banks, which issued money and which accepted deposits, but they were outside of the regulations. So this is called shadow banking. Basically, banks operating without any constraints on their operations.
And Professor Saab, in the late 90s, we've seen the rise of derivatives. Now, maybe you could perhaps help us understand what derivatives really are.
Well, basically, in 1999, the Glass-Steagall Act, which was the main, which basically prohibited banks from speculating, that was struck down. In 2000, the Commodity Futures Modernization Act was passed, which basically allowed banks to create these instruments called derivatives. Derivatives are gambles on anything at all. So, for example, I can gamble. So a bank gives a mortgage loan to some person. I can make a bet that this person will not be able to pay his loan. And so if I make, this is a derivative, because there is an original transaction. The original transaction is the mortgage loan made by the bank to the person who is buying the home. Now, a bet on the outcome of this loan is a derivative because it is derived from the original financial transaction. So the derivative says that this person will not be able to pay. If he is able to pay, if he is not able to pay, I will pay you so much money. And if he is able to pay, then I will get so much money, something like that. So what happens is that this acts as an insurance. If the bank gives a mortgage to somebody who is not worthy, and then it sells a derivative, so that if the person doesn't pay, then the bank makes money. So then the bank is covered in both cases, because if the person pays, then the bank gets the money, but it doesn't get paid for the derivative. If the person doesn't pay, then the bank gets paid by the derivative. So in either case, the bank is covered. So once this kind of thing was allowed, and then there can be super derivatives. Somebody can bet on the derivative itself, that this bet that has been made, I think that this bet will go on that side, and so on. So you can bet on bets on bets on bets. So at one point, after these were allowed, the real trade in the world was around $4 billion per day or per month, I don't remember. And the derivatives, which were bets being made on the exchange rates, associated with the foreign trade, they were on the order of 20 times that or 100 times that. So basically, there's a huge gambling market that has been opened in the financial affairs by the use of this derivatives.
Going forward, are we coming to the end of fiat money? What will money be like in the future?
Well, the issues are quite complex. One simple idea that many people have is that everything will be fixed if you go back to the gold standard. This is completely wrong. The gold standard cannot be used today. So what will money will be like? If you think pragmatically, then basically since the Nixon Shock, this has been an era of dollar hegemony. The U.S., the de facto, the current state of affairs is very, very strange. Basically, the U.S. has a gold factory. It can print as many dollars as it likes, and it will cause no damage to their economy, unlike anybody else. This has been a very great source of the wars that we see around us. From the very beginning, the creation of money, the power to create money has been very strongly and closely linked with the possibility of wars. Because to conduct a modern war requires a huge amount of money, and basically the creation of money for this purpose was the reason why central banks were invented. And even to this day, the fact that the US can print money enables it to run a continuous state of warfare all around the world, with printing trillions of dollars without any consequences. And so this one-sided system where only the US has this power and nobody else has this power is very harmful, and many people have realized it. And now there are some efforts being made by contenders, like the European Union invented the euro partly to counterbalance the dollar, and the Chinese renminbi is also coming into the picture as one of the big currencies and the big players in the game, because the Chinese trade is now globally near the top, if not the top. So a multipolar system is likely to emerge, where we have euros, we have renminbis, we have dollars, and maybe some other currencies if they manage to
that gives us a good platform to understand the issue of money, and there are obviously other aspects that come from this, and perhaps the issue of Bitcoin, or all of that which is linked to what we say cryptocurrencies. So those are some of the things that we look forward to tackling in the coming weeks. Professor, Jazakumullah khair once again for your time this morning on Radio Islam.
Thank you very much.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam.
That was Professor Asad Zaman speaking to us from Pakistan, giving us insight on the issue of money.